Good morning, traders. It is Monday, March 10th. Taking a look at the charts, we got lots more action today. We've got the equities market selling down. Again, that fear is carrying over from last week. Now, more or less, we saw the market try to do a little shakeout on Friday earlier in the day. We had panic selling the Thursday, and it kind of flushed down on Friday morning. And then we saw a little bit of a bounce and rebound. Overall, when you look at the downtrend, it really is, it's not a rally or a bounce. It was just a little tiny bounce. And today we are going to be right back down near those lows from Friday as the selling pressure continues to carry over. Now, let's look at a few different things here. Now, overall, you notice this is a fairly significant low that we've got going on over here. We have a huge elevated spike in volume, so there's definitely a big sentiment shift. There's a big wave of selling. We've seen this similar over here as well. Big volume picking up as everybody kind of runs for the door and moves out of things. So we've seen waves of panic selling. When we look at our other chart here, we've had a couple days here of panic selling, another day over here. We had another day over here of panic selling. So there's bouts of panic selling, and it continues to pick up. And the VIX continues to go higher as the fear increases, and we'll probably see the put-call ratio spike up again today. Now, overall, I think the key point here is to just look at kind of where we are from a cycle standpoint. We have these red bars here down at the bottom, which tells us when we have a cluster of cycles putting in a low. Now, it's more or less the price still needs to reverse and trend to say, hey, this is a standout low. But typically, when we have multiple clusters of a cycle low, it usually becomes a fairly standout, significant point on the chart at some level. There was actually one right over here, too. Very short-lived, but quickly rebounded and moved higher. So we have some interesting price action going on. There's quite a bit of damage being done to the chart. I do feel like momentum of the stock market for the first time in the last really couple of years, it feels like that momentum is truly stalling out. In terms of the Magnificent Sevens, stocks losing a lot of their momentum. And depending on how the Magnificent Seven bounce over the next month or so is really going to dictate where we are. If we look at the Magnificent Seven, these things control the market direction. And there's been a lot of damage done, broke this pivot low. There was a lot of damage done back over here as well, and obviously it recovered and went to new highs. But obviously there's a big difference here. If we look at this volume, this means the whole world has piled into the Magnificent Seven right here. If you take a look at this volume and we just kind of box this in, that same window, like everyone piled in the Magnificent Seven right here, and this is how it typically works. FOMO gets the best of most people who don't understand the markets, and this is where they feel like they have to get in. Everybody's in it, and it's going higher, and they literally all buy near the high, and then the market sells off, and they just take a loss. And so when we see FOMO and we see this type of focus on particular stocks, that usually is, this is the mass participants getting involved, and institutions start selling off into that, creating, so as there's tons of interest in it, the institutions keep unloading their positions and trying to get out at the high and load, give all their shares to those who don't know what they're doing. So this is a big red flag. Depending how this plays out, I think we're going to see still a potential decent bounce in the market. It could come back up to this breakdown level, or it could flag sideways and build some type of little bear flag. But I do believe we're going to start to move lower. And I kind of touched on this last week. Let's go to the SPY or SPY here. If we take a look at the SP 500, let's just zoom into the price chart here. If we take a look at the SP 500, you'll notice it has this kind of higher highs and higher lows, and then eventually kind of puts in a top, and then it starts to make lower highs, lower lows. I shared this in the comment section last week. I forgot to put it in the afternoon post. Let me see if I can pull it up here. Take a look at this. I will post a link today again for this. I did this little right up here, just showing how the market's top. Let me zoom in here. This is kind of how the market's top. We have a series of higher highs and higher lows. Eventually it puts in a head and shoulders, or it could put in this triple little top here before breaking down, or it could even just put in a double top and then break down and start to make lower highs and lower lows. And I kind of show an example of the silver chart back here where it did that pattern. Again, it's not always perfect like a bandsaw blade kind of rotating over, but you get the gist. Eventually it puts in a peak or a double top and then starts to make a series of those patterns. So if we were to just focus on these rising highs and then falling highs, and we go and look over here, you can see we have that. We have these bandsaw blades coming up. We've got this potential little triple top here. Now we got the break to the downside, and then we kind of go like this, and the market obviously changes direction. And so that's kind of what the big question is are we going to get a bounce, a lower high, and then is it going to get sold into? And especially if the Magnificent 7 do this, the market is definitely screwed because they are just going to drag the indexes down with them. And again, when the tide is going down, you do not want to hold stocks. All right, so this morning we are seeing the equities trade quite a bit lower. The S&P 500 is down 1.4. The NASDAQ is down 1.6%. So we're seeing a big move. Friday didn't quite play out the way I really wanted it to play out. But overall, I was really hoping for a big sell-off into Friday at the close. And then today we get even more selling and a big gap down. We're getting the gap down today. And if we just look at the S&P 500 30-minute chart, we're going to gap. We're set to gap right down at this level. So the market is going to gap down here, and it's going to put in potentially a short-term double bottom. So the fear from yesterday, this is what I was hoping was going to happen on Monday. The fear from on Friday and Monday, which was people are still fearful, even though the market had a little bit of move up and gained a little bit of ground on Friday. Everyone's still scared over the weekend who doesn't pay attention to the markets. They hear about it and they're like, holy crap, the markets are down like 10% from the highs, and it's selling in free fall mode. So they're all going to get out at the open today. They're selling, and the market sees all these orders standing there, and the general public is going to get out for potentially a little bit of a double bottom. And as we know, gaps get filled, meaning this could be an exhaustion gap. This is the masses all getting out at the kind of right near a low, on a cycle low, all on FOMO and emotion built up over the weekend. And the market's probably going to rally up and fill that gap and then potentially put in a bottom and start that bounce. When we look at the daily chart, we're going to be looking for a bounce over the next couple of weeks. And then the big question is, how big of a bounce? Is it a bounce before going lower, or is it a bounce before building a pattern and going higher? We don't know yet. We just have to take it one bar at a time. One other thing I do actually want to quick mention, thanks everyone for your comments about I'm doing this fasting, this multi-week fasting. It feels absolutely amazing. And it's amazing how many of you guys have done different ways of fasting and cleansing. Definitely pretty interesting stuff. I can't get enough of it. And so it's great to see your stories, hear your stories. I am, it's kind of in preparation. I'm doing a test to see how lean I can get, kind of on a real health kick. I want to get fit. I am doing Kilimanjaro in 2.5 months with my friends. So I want to definitely shed some weight and not have to lug it up the mountain, which is part of the plan. Anyway, let's go back to the charts here. Where is going on? Where is money flowing today? We are seeing money flow into bonds. Bonds are having a little bit of a bounce. They're definitely finding a little bit of a shift. I think if we take a look over here, moving averages have been going down. We finally have a crossover on the 20 and 50. We have the 50-day and the 20-day above it and the 5-day above it. None of this is a buy signal really yet, but we do have upward momentum. The moving averages are layered properly, where the long-term trend is up, the 20-day is up, 5-day is up, price is above even the 5-day. So it is showing we have some life in this market. And what's interesting is there was a lot of damage done in the stock market last week, really kind of shifting that momentum from still a bullish buy the dip to like now it's like, okay, if you're lucky, you can get out and sell the bounce and try and get out, at a higher price. Feels like a lot of people moved into bonds, big money or something was moving into bonds. This could be telling us there's a big shift. Bonds could become that defensive play. And as we've been watching, you can even see bonds dipping into oversold territory on Friday and I think last Wednesday or Thursday. But bonds are trying to put in this bottom on the chart. It's been coming down. We're in a stage 1 base for that chart. Again, I think the economy is coming around and becoming very weak. If we look at some economic data, I find some of this stuff pretty interesting. We don't take it into our trading account, but we definitely, it's nice to know the momentum. I think all this plays a very important role in being mentally prepared for a weak economy. But take a look at the average hourly earnings change year over year. We are seeing average earnings come down, so that frothy that everybody's had and high pay has been kind of fizzling out. So that is a sign that employers aren't looking for as much work. They're not as high as demand. They're not paying as much. They're not in desperate need to get employment like we were at one point before. So that is a sign that the businesses are slowing, economy's slowing a little bit from an entrepreneur standpoint. Take a look at the unemployment rate. We have got, obviously, as a technical analyst, we've got employment rate hitting lows. And we have a little bull flag here, and it's rallied up. It looks like a pretty much perfect measured move. Rallied up, pull back. We're now in another bull flag, which we could take this pattern, and this is the bull flag, and draw that to the upside. That's probably pointing to 8% unemployment over the next year or so, or a year and a half potentially, telling us that unemployment is in an uptrend. It's just taking a pause, and it's probably about to shoot higher. And the funny thing is, this measured move based on this bull flag brings us right up into this other level, which is going to be a previous high, previous pause. So there's definitely, I think we're on the verge of unemployment. And if that happens, then we're going into more so a recession. When you look at the big picture, this is the little bull flag. There's a lot of room for unemployment to really shoot up and really take off. I think this is a bit different type of gauge on the unemployment, but overall, there's a lot of room for unemployment to shoot up and pick up speed. And these little hiccups along the way, very similar to what we saw back in 2007, where it rallies up, it takes a bit of a pause. Eventually, just the markets break. When the markets break and the bottom falls out, we see things just shoot up. Same with COVID. Pretty much every time we hit a recession, it just spikes. Businesses lay off right away to try and protect themselves, save their money. Let's take a look at the housing market real quick. 2005, 2006, we eventually saw this shift of higher highs and higher lows, and then suddenly it made lower low and lower highs. And of course, the markets break down very quickly. They fall a lot faster than they go up. And that's pretty much in every asset class, including real estate, as you can see here. So we started to see the housing market top and start to slow, and then the housing crash took place a lot later. This is a leading indicator. We've got the same thing over here. 2020, we saw a big spike. We do have, more or less it's making a series of lower highs. It does have some higher lows here, but overall the momentum is shifting. And if we take a look at the new homes, single-family homes of all constructions, we're getting back up to the inventory level that we saw back during the 2006, 2007 major market top. There's a ton of homes. Everybody built, subdivisions everywhere, multifamilies everywhere. It's just crazy. The crazy part is nothing is really selling. And that is why there's so many homes for sale, is nobody wants to buy. I was talking to a real estate agent over the weekend, and they said, a lot of people, they have a different perspective, but more or less they're like, yes, nobody's really buying right now. It's painful to be a real estate agent. Nobody wants to pay the pricing. And this is the median price. The prices have been fading down. There's been a little pop on the monthly. And it's interesting because I know a few people now that are looking for homes. They're getting excited, or some new properties saying, hey, pricing has come down a bit more, and they want to start looking for something. I think it's way too early. I think we're going to see the housing pricing drop dramatically. And once the bottom falls out, it goes very, very quickly. And there will be an opportunity in the next year or two, I think, to pick up properties at a fair value, where the numbers actually work and where you can actually pick a property that fits what you're looking for, not just buying what is available and still, the numbers are out of whack. So that's kind of where we are in the grand scheme of things from kind of all of that. And all this stuff is telling us we're getting closer and closer to a big shift. Something is about to break in the markets, and we don't know what's going to cause it. It might be tariffs. Who knows what everybody's going to blame it on after it happens. But overall, unemployment is about to pop. Housing market is about to drop. All these things coincide. Obviously, if unemployment drops, people can't afford homes. Home sales stall out, and people have to lower their home prices to sell them. And then, of course, all that kind of unfolds as like that. Let's take a look over the VIX, up 13% this morning. Again, going back, let me just get rid of some of this Overall, if we take a look at the VIX, it is up at some nosebleed territories. There's a lot of fear in this market. It keeps the fact that it's dragging out for several weeks versus a big spike that happens in 2, 3, or 5 days. This is telling us there's a momentum shift happening this time, I think, where the trend could be actually turning and the major market top may be in. So that is really interesting because I think most of us here, the technical traders and members, we're all ready and wanting a big market correction. Not only can we profit from it, but it's going to allow us to reinvest our capital, get through this difficult time, a couple of years of pain for most people, and then we'll be able to, ride the next major bull market and invest in some new assets and take advantage of precious metals and probably uranium stocks and real estate and all of that stuff, and buy dividend stocks at a fair value when the dividends are actually really high. All right, let's take a look at Bitcoin really quick. Down 4 or so %. Again, it has a bearish pattern. We ended up taking advantage of it right here. We got in here. We got it right up here. It put in a double top, and obviously it's rounded off, and now it's broken below this level. It had a bounce up with news and Trump, and now it's back down. This looks like it is going to drop down to probably 7,000 or 7,500 very quickly here. Again, it's just lost its momentum. And this is why we don't fall in love with an asset class. We get in, we make our money, we get out. And sometimes we get in and we lose a little bit because it doesn't can want to move in the direction that it was telling us it looked like it was going to go, and we cut our losses and then it moves down. It's all about managing risk. It's all about not falling in love, hate the market, just always think you never want to be in it. You just get in it, you try and make the move and then get out and sit in cash and wait for the next setup. That is the best way to look at it, although everybody else wants to hold all kinds of stuff and they fall in love with stuff, but it's the wrong way to look at the markets. Think of the market as your enemy, constantly trying to take your money. And you just get in when the momentum shifts, you catch that wave, get out, and move on. Other than that, I think let's take a look at the long-term picture here. The stock index is, again, testing now the key moving average, like 200-day moving average. We're going to see if it gets some traction. This phase, as we've talked about, is very similar to this phase. It did hit this nominal new little high before going into a small bear market. We hit this nominal new little high a couple of times. We just tagged it, and now we could go into a small bear market. And the question is, does that bear market turn into a stage 4 decline, which means we get into something a whole lot bigger where eventually we break these 2022 lows and have a bigger, much bigger sell-off. If we take a look from these highs, there's potential here to go down 50% or so. We've seen a lot of market corrections of 50+%. That would break the 2022 lows. That would be a huge reset. There are people saying they're expecting even bigger. Obviously, there's always those crazy fear mongers that go down 65. Some of them are saying like 70%. I'm not sure about that, but I am expecting a 40 to 50% correction and the break of those lows and a whole new economy emerging that is going to be very AI driven. If we go back and take a look at 2008, my data doesn't load that far back at this point for this particular chart setting, but you can see the sell-off size that we had back in 2008. It was a 57% pullback in the SPY. I don't know what the QQQ was. I'd have to look, but I think it was like 75 or so percent, or maybe not so much for this one, but the tech bubble was huge. So anyways, that's where we are in the grand scheme of things. Overall, big trend is starting to stall out. I believe we're in this stage 3 topping phase for the majority of the stocks. Again, the stock indexes kind of cover up this pattern because of the Magnificent Seven, but behind the scenes, the stock market is putting in a double top. A lot of sectors are putting in a big bear flag, and we're about to start into a financial reset, a big one. Not a 20% pullback, but like a 50% pullback. And again, that brings us down to like how you need to navigate these markets, which if we take a look at these strategies, the key here is to understand we're in a stage 3. The best strategies are ACS, OTS, or TTI. ACS is our adaptive compounding strategy, which can profit in all market conditions, and the strategy evolves and changes with the markets. OTSs are options trading signals, which is writing options, advanced options. And then there's TTI, which has an asterisk here because TTIs are technical investor. It is great until the market trend finally reverses, and we're getting very close to that trend reversing. And then, so the TTI really works for only halfway through this stage 3, and I think we're getting very close to that breakdown in TTI. And if we were to look at the TTI chart here, you can see we are getting very close to the trend eventually changing. The last time we had a trend change was right over here. So it takes some time for the markets to put in that series of bandsaw blades and a break to the downside, and really for that market to change direction. So we could see some damage, and then eventually we're going to see some bounce, and then we could have some trend change over the next several weeks from a bullish phase to a bearish phase. But we'll just have to wait and see how that unfolds. Anyways, that's it for now. We'll see how things go from here, and talk to you soon. Bye-bye.